Netflix just reported earnings, and in this video I am going to do an in-depth analysis by looking at their earnings, their balance sheet and income statement, and using my Excel spreadsheet to see what price you should pay for Netflix stock. Their earnings came in mixed. As you can see, they missed on revenue, but they beat nicely on EPS, and they also beat on net additions. They managed to reach 5.89 million new subscribers versus 2.1 expected. This is due to their password sharing policy. Another important highlight from their earnings is that their margins are improving and their free cash flow impressed at $1.3 billion, above the consensus of 542 million. They also expect revenue growth to accelerate in the second half of 2023 due to their password sharing and their new ad business. So we'll see how that plays out in the future. Now let's take a look at the financials of this company, and let's start with their income statement. If we take a look at revenue growth, we can see that this company logically grew a lot during COVID because a lot of people were staying at home, but naturally that revenue growth has come down. And if we take a look at what analysts are expecting for the next 5 years, they are expecting around a 10% revenue growth rate for the next years. Now let's take a look at net income and free cash flow, because there is a huge difference between both of them. If we take a look at net income, last year they made $4.4 billion of net income. Again, net income jumped during COVID, so we need to ask ourselves the question if it is going to continue to decrease to reach the levels they used to do prior to COVID. And then if we take a look at free cash flow, they currently have $1.6 billion of free cash flow, which is substantially lower than net income. We are also going to see this clearly in their margins, where they currently have a 14% profit margin. Profit margin comes from net income. And then if we take a look at their free cash flow margin, it is currently at 5%. These years of negative free cash flow margin do not worry me because the company was in growth mode and they were spending their money to grow. However, I do not like the difference between free cash flow margin and profit margin, because profit margin, which comes from net income, is a lot easier to manipulate from free cash flow. But we have seen on the recent earnings that their free cash flow impressed at $1.3 billion, so maybe free cash flow is going to continue to increase from now on. In order to see what price you should pay for Netflix stock, I am going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I am going to do low, middle, and high assumptions for the next 7 years. Starting with my revenue growth rate assumptions for the next 7 years, we have seen that revenue growth has come down to 6% after COVID, and analysts are expecting around 10% for the next 5 years. I definitely think that 10% is achievable because of the new password sharing policy and their new ad business. So I'm going to put 10% in the middle, 13% on my high assumptions, and 7% on my low assumptions. Moving on to profit margin and free cash flow margin, we have seen that there is a huge difference between both of them. They currently have 14% profit margin, which is what I'm going to put on my middle assumptions. On my high assumptions, 17%. And on my low assumptions, I'm going to put 12% because there is a lot of competition in this space and in case they struggle. Then regarding free cash flow margin, they currently have 5%, but I definitely think this is going to improve over the next years. So I'm going to go for 6% on my low assumptions, middle with 8%, and high with 10%. Moving on to PE and price to free cash flow, the average of the stock market is around 15. However, you should assign a higher moat to companies that have growth, which Netflix has, and companies that have a moat, and Netflix definitely has a moat. So I'm going to go with higher PEs and price to free cash flow of 17, 18, and 19. Finally, the discount rate is the return you want to get each year on your investment. And because you can get around 9% investing in an ETF, if you take the risk of investing in an individual stock, your desired return should be higher. So I'm going to go 10% on my low assumptions, 12% on the middle, and 14% on my high assumptions, because as my assumptions get less probable, I need a higher desired return. As you can see, according to my Excel spreadsheet, the stock looks overpriced. The stock is not even a buy according to my high profit margin assumptions of 17% and 13% revenue growth, as the buy point in this case is $300 per share. I also want to say that this Excel spreadsheet does not take into account the balance sheet, so let's quickly take a look at it. The debt of the company is essentially the difference between the market cap and the enterprise value. In this case, is $6 billion. And this is very little debt, essentially no debt, so this is definitely a positive for Netflix stock. In conclusion, I am personally going to pass on this stock for the following reasons. Number one, that their free cash flow is significantly lower than their net income, although I do think it's going to improve over time. The valuation looks very expensive, and there is a lot of competition in this space. However, remember that you should always do your own analysis and do not buy or sell just because I say so. I hope you enjoyed the video, and I'll see you on the next one.